everyone. Domestic equity markets saw an up move in the month of July 2022. As we speak till July 28th, month to date, we have seen the large cap Nifty index rise by about 7.3%, while the NSE mid cap index is up by over 10%. In fact, during the second half of the month, equities witnessed a strong rally as commodity prices declined, providing more hope on peaking inflation levels. On the global front, however, the tug of war between growth and inflation continues. The Federal Reserve delivered its second consecutive 75 basis point rate hike. The European Central Bank, for the first time in 11 years, raised its policy rate. While inflation in the US remains a challenge, there are signs of slowdown in growth both in the US and Europe, and this is on the back of weakening consumer demand and sentiment. In this context, India clearly is an outlier, with growth remaining resilient. Coming to flows, FIIs have been net sellers in Indian equities in this calendar year. However, the pace of FII selling has moderated sharply in July. In fact, for the month of July so far, FIIs have been net buyers, though small, to the tune of almost $47 million. Calendar year to date, the net FII selling stood at about $28.5 billion. However, in the same period, domestic institutional investors have been net buyers, and CYTD, DIIs have been net buyers of Indian equities to the tune of $31.6 billion. Now, these divergent trends are reflected in ownership of NSE 500 stocks. FII holding in NSE 500 stocks was down 190 basis points YOY to 19.8% in Q1 of FY23. For India's largest 75 companies, domestic ownership at 25.6% is now larger than FPIs for the first time since 2010. The trend in retail flows into equity markets continued to be positive via the mutual fund route. Mutual fund equity inflows have remained largely robust, and flows have been positive for 16 consecutive months. Systematic investment plan flows also remain fairly robust. Coming to corporate earnings, as you know that the Q1 FY23 earnings season is currently underway. So far, around 22 Nifty companies have reported numbers. In terms of revenue, EBITDA and net profit, growth rates were about 30%, 9% and 11% YOY respectively. Numbers have been somewhat lower than estimates, but the miss has been driven by one or two companies, and X of this, numbers have been largely in line. Now, while we acknowledge that there could be near-term challenges to earnings because of higher input cost pressures, structurally, India appears to be on track to deliver mid-teens earnings growth in the medium term. Corporate profit to GDP is at a decadal high. For NSE 500 companies, profit to GDP ratio stands at 4.3% in FY22, and this was 2.2% in FY20. In terms of valuations, Nifty valuations in terms of the price to earnings ratio have corrected. Valuations are more reasonable, closer to a 10-year average level. However, when we look at valuations on a relative basis, valuations remain elevated, and this is one of the key variables for FII flows. So what are we really saying for markets? For markets, there remains many moving parts, and hence some volatility could continue in the near term. However, commodity cost correction has been positive for Indian markets, and we've also started seeing some stability where FII flows are concerned. In the second half of FY23, if commodity prices continue to correct, some of these uncertainties would be behind us. Focus then would shift from inflation to trajectory of growth, and in that context, growth in India has been resilient in relative terms. Therefore, while markets still may not be very cheap on relative valuations, stocks have corrected, and at a stock level, valuations are looking attractive in pockets. We have been of the belief that this will be a year of bottom-up stock picking, and therefore, we are looking at companies which are market leaders in their sectors, which have strong balance sheet and cash flow, but where valuations are not elevated and are reasonable. There are 4 key sectors we are positive on. The first being domestic cyclicals, that is manufacturing, industrials, and infrastructure. Here, Growth continues in the public capex side. There are signs of improvement in overall capacity utilization levels as well. This improving trend in capacity utilization, along with better corporate profitability, ensures that the stage is likely set for a new leg of the investment cycle. Now, investments are also happening in new sectors such as renewables, battery storage, green hydrogen, as well as a move towards indigenization of defense, which is attracting investments. The second area where we are positive on is financials, specifically private sector banks. For banks, the focus has moved from asset quality to growth and liabilities. In a rising interest rate environment, those with higher low-cost deposits, as well as those with higher floating rate loans, are better placed. Private banks are gaining market share, credit costs are normalizing, they are well capitalized and well placed on technology. The third sector that we are positive on is real estate and home building. Here, demand remains strong despite some inch up in interest rates. There is higher affordability, which is supporting demand. Inventory levels in the sector has seen a decline, and the sector has benefited from a policy push. And finally, specialty chemicals. We remain positive on the growth prospects in the specialty chemical sector, even while valuations have run up a bit. The sector remains a beneficiary of the China Plus One strategy, and it is likely that India would continue to gain market share in the global chemical industry. Overall, in our asset allocation bucket, our view is neutral in terms of equity, with a slight preference for large cap. Our hope is that the second half of FY23 would be far calmer than the first half. We would urge investors to continue with their disciplined approach to investing, keeping in mind their overall asset allocation strategy, investment goals, and time horizon. Happy investing. Thank you very much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.